We have focused much more on buying into companies that earn lots of money in other currencies on the thought that they will be somewhat favored over companies earning just US. But that's not, as I mentioned in the report, that is not a huge determination of what we buy. It's a factor, but it's not 50% of the decision or anything like that. We are following policies in this country that are likely to cause the dollar to decline in value against many major currencies. And who knows what speed, whether it happens this year or next year, we don't have any idea on that sort of thing. But the fundamental forces are fairly strong. We actually only own one currency now, trade, which would surprise you actually. We'll tell you about it next year. Charlie?
Yeah, so far something peculiar has happened. During this exact period of maximum dollar decline in value versus other currencies, the dollar prices at Costco have showed an inflation factor of approximately 0. So what really matters, of course, is how things are working in your own country. And it's been perfectly amazing how well we've gotten by so far with the decline of the dollar.
Yeah, as Charlie says, we reference everything in terms of our own country. If you look at oil, for example, which we'll say has gone from roughly $30 a barrel to $60 a barrel over the last few years, during that same time, the euro has gone from like 83 cents to $1.35. So the price of oil, if you're a European, has gone up very little. I mean, we think oil's run wild, but in terms of anybody that's using the euro, the price of oil has gone up about 25%, and we feel the price has gone up 100%. So you do have this anchoring of thought to your own currency, which is understandable. I do think you'll need to think about currency matters more than Americans traditionally have. I was struck 20, 30, 40 years ago when I would travel elsewhere how much more sophisticated most people in Europe, in the UK, wherever, were about currency than in the United States. We never had to really think about it because everything was dollar based, and an American didn't have to be smart about currency or even think too much about it in terms of their business. But that world has changed. I would say that most writers and most shareholders probably have a little bit of a distorted version, at least how most corporations, large corporations, have operated over the years. Usually, for a long time, I would say that directors generally were sort of potted plants. I mean, you sat there and the management had its agenda and didn't really want input on major matters. And Charlie and I can certainly testify the fact that we have had great lack of success, even when we were the largest shareholder of a company, in terms of talking about the things that really count. I mean, if somebody spends their whole lifetime, 25, 30 years, rising to the position of CEO, they want to be boss, and you can't blame them. And the only thing in their way is the board of directors. So they look for people who are big names, and they look for ways to keep them happy. But they don't really want them getting into the business very much. There's a lot more process now that's been imposed by the recent rules. But I would say still, in terms of the reality of the guts of business and the discussions that take place and all that, I think you might be surprised at the level overall of that throughout corporate America. As I've written in the report, overwhelmingly the job of the board of directors is to have the right CEO. I mean, if you've got the right CEO, 90% of it takes care of itself. If you were a director of Cap Cities and you had Tom Murphy as the CEO, case closed. It was all you needed. And if you have that CEO, I think you have an obligation on the board to make sure that there's not overreaching by the CEO, because the CEO can have different interests. And I think the third thing that the board should do, is they really should bring some independent judgment in on major acquisitions, because there is a natural tendency for people with usually big egos, big motors, who get to be CEOs to like to do big things and to become bigger, spending other people's money. And normally when big deals come along, the management, by the time it gets there, they've made the deal anyway. They have investment bankers there who go through a little ritual. I've never seen one come in and make a presentation that says it's a dumb idea. I mean, they know what the answer is supposed to be, and it just becomes kind of a little game. So I think in those three respects, a good director will first make an affirmative decision. You've got a very good CEO, not the best in the whole world, not everybody can do that, but very good CEO, that CEO is not overreaching, and when significant deals come along that they get a chance to weigh in, and that you really get a balanced discussion about the real economics of what you're doing. And I would say in that latter point, what I've seen over the years has really been pretty bad, but I can understand it, because the CEO wouldn't bring in the deal unless he wants it done, and once he brings it in, he's going to stack the deck and make the presentation in such a way that it's almost impossible to exercise independent judgment. Charlie, do you have any thoughts on?
Yeah, I think big deals on average in America are contrary to the shareholders' interest. That's the way to bet.
Yeah.
I think on the acquirer's side, usually the shareholders are worse off.
Most stock deals, they think about what they're getting and they don't think about what they're giving. I mean, I've been involved time after time where people are giving a significant percentage of the business which they wouldn't sell at the current market price. If somebody came along with a tender offer 20% higher, they would say that's inadequate. But they hand away a piece of the business because they want to own something else. And there's nothing wrong with that, but you just have to be sure that you're getting as much as you're giving. I have very seldom heard a discussion. In fact, I don't think I virtually ever heard it, a discussion of weighing what you were actually giving away on a stock deal versus what you're getting. I've heard a lot of discussion about dilution and when dilution will be overcome and all that sort of thing, but that is not the question. The real question is, if more value is being created, how is it being whacked up between the two companies? And if not extra value is being created, are you getting more than you're giving?